Hello everyone, and welcome to the final session of day one of AngelList Confidential, where we'll be presenting some results based on AngelList's unparalleled data set of early stage startup investments. I'm Abe Othman. I'm the head of research at AngelList. My work at AngelList, involves a lot of data and math, but I also try to stay connected to the actual process of startup investing. You may be familiar with some of my research. I think my largest contribution to date so far has been in uncovering the structure of power laws within startup investing returns. The hypothesis being that seed stage investing in particular follows its own very special power law that encourages or would suggest that LPs could benefit from broadly indexing across credible seed stage investments. One of the things I'm proudest of was to be featured in Matt Levine's Money Stuff newsletter a few years ago, where he summarized my research under the very accurate headline, "Just Buy All the Unicorns." In addition to my research, I also operate AngelList's early stage quant fund. That's a relatively small fund that we use to invest mostly in the startups who are attracting talented candidates on what used to be AngelList Talent, but is now the Well-Found platform. I'm also an active angel investor. Some friends and I operate a partnership, no LPs, called Indicator. That has been doing seed investing since 2016, and I personally have been doing seed investing for a decade now, since 2013. I didn't really have a great place to put this, so I figured it should be in the intro. I know there's a lot of people with different backgrounds listening to this talk. Some of the abbreviations here, acronyms, can be a little bit off-putting, so I wanted to just have a slide to talk about some of the terms we're going to be using in this talk. Some private equity math, and because it's private equity math, it's not particularly challenging, but it is filled with abbreviations. So the key one here is TVPI is RVPI plus DPI. That would be total value to paid in. That you can think of that as the net multiple to LPs. RVPI is residual value, which is unrealized returns, and DPI is distributed value, that's realized returns to LPs. So all we're saying is that all the money you've invested, its current value is either unrealized or realized. There's nothing too complicated about that. The other key concept is that IRR, which is a rate, compounds to TVPI, which is a multiple. So we have two kind of different, IRR measures a flow, and through time it compounds into TVPI, which is more like a stock. I realized from the title that it may have been misleading about what this talk isn't about, so I wanted to just mention this talk is not about how to measure how relatively good a GP's current track record is. If you are interested in solving that problem, I would direct your attention to the AngelList Fund Performance Calculator, which is another product of the research that we've done. It lets you input TVPI and IRR and get a 0 to 100 percentile score for any recent venture fund with, I would say, reasonable, as we heard from Jake earlier in an earlier session. It does not cover extreme cases like exceptional 14x performance, but for typical performing funds, this will give you a 0 to 100 score. You can find it at the bottom of any AngelList.com page by just clicking on the VC Fund Performance Calculator link. I did want to mention our Fund Performance Calculator because occasionally, a few times here, you'll see references to percentiles in place of where you may have expected to see IRR. In your mind, if you just want to replace percentile with IRR or with corrected IRR, it's fine. All the results still hold up. I just wanted to mention this. I'm not trying to sneak anything through by using our Fund Performance Calculator percentiles for some of these plots. All right, so that's not what the talk is about. What is the talk about? This talk is about trying to answer this question. Can you use track records to figure out which early stage venture funds to invest in? This is a really challenging problem. In fact, a friend of AngelList, Bern Hobart, has said that essentially judging VC skill, i.e. presumably finding the VCs you want to invest in next, he did a very interesting Substack post a couple years ago where he referred to it as potentially the hardest open problem in finance. All right, why is it so hard? It's hard for two reasons, robustness and timeliness. Every good measure of VC performance takes too much time, and every near-term measure of performance is not reliable. Especially in the current environment, there's been a lot of discussion around unrealized marks. And I think it's very easy for LPs to say, you know, are these unrealized marks all bullshit? Like, is this real? You know, what I care about is cash back. And certainly, I'm not going to disagree with that. Fully realized distributions coming back to LPs, that is DPI for mature funds, is a great measure. The challenge is it takes too long. And setting up a bad joke, well, how long does it take? The answer is it takes so long, I can't even tell you how long it takes. Let me be specific about that. So in preparation for this talk, I went and looked at the earliest. So AngelList as an investment platform has been around now for 10 years. The first deals on the platform were done in early 2013. You know, the platform was a different place back then. You know, this was a relatively small number of deals. They were, you know, interesting. I'm not sure that we would do those same deals today, but you know, this was 10 years ago in a different environment and a much, much smaller platform. But when you look at the performance of the oldest deals on the AngelList platform, so about like this is, I think, 75 deals or so from 2013 and the first half of 2014, what you see is that the residual value is more than half of the value of those investments still. And as part of this, I actually went through and looked at some of those investments, and you know, those are real companies. They just haven't become realized. They haven't become liquid yet. And these are, again, the oldest investments on the platform, 10 years old. Now, it is true, AngelList is an early stage platform, so you could say, well, perhaps venture as a whole, this doesn't hold. But in fact, when you look at PitchBook's benchmarks, you see that almost half of the value of 2013 venture funds is still residual. And then if you go all the way back even to 2010, you see that more than a quarter of the value of venture capital funds is still residual. And then, you know, these are still a significant amount of residual value in 2010 funds. You know, LPs making those investment decisions may have made those in 2009. I mean, you're getting into the financial crisis or even before the financial crisis to start seeing that. So when I say that I don't know how long it takes to get these fully distributed values that are you know, actual real cash, it's taking us to before the financial crisis. So I really don't feel comfortable even projecting that. Okay, so you can say, well, all right, I'm not talking about fully realized value, but what I really want is to see, you know, cash on cash returns to get back to LPs. And the challenge with that is that, and it's wonderful, right? If you have a GP who invests in a company that just is a rocket ship and you know, IPOs within a couple years and returns a ton of money back to LPs, like that's wonderful. The challenge is that happens extremely rarely. And so what you get from the benchmarks are very, very small numbers to get to a comparatively very high ranking. So again, to put some data behind this, PitchBook's top quartile DPI for 2018 vintage funds, so 5 years ago, is just 0.33x. And for 2020 funds, which are reasonably kind of the funds now that a GP could be raising a successor fund for, it's 0.03x. LPs should not make decisions on, so you could imagine a GP could tell you, well, my 2020 fund ranks in the top quartile of DPI. It would be misleading for LPs to view that as anything, you know, you could get that mark by returning 0.04x to your LPs. LPs should not be making, you know, venture is a space where, you know, an ideal fund would return 5x or even more. LPs should not be making their decisions based on a GP returning 0.04x in 3 years. So near-term distributions are not the way to solve this problem either. So what does that leave us with? The answer is IRR. IRR is currently the default way to judge and predict a GP's performance. The challenge to IRR, I think, I have my own data on this, but PitchBook said it really well in a report about 2 months ago. After controlling for information on prior fund family returns that was available at the time a successor was fundraising, the predictive power of a GP's track record is near zero. What does that mean? Well, let's look at some AngelList data on that as well. So what I did was I sliced this so that looked at a GP's prior fund as of January 1st, 2020, and then looked at their next fund and its current performance as of a week ago. Depending on your preferred measure of correlation, Spearman or Pearson, the correlation here is either minus 0.1 or maybe 0.1. Let's call it 0. PitchBook's line, so this does back up PitchBook's statement that essentially there's not much relationship between IRR now and the next fund's IRR in the future. But I do want to mention, does that PitchBook quote, they said track record, they didn't necessarily say IRR, and the question is, does PitchBook mean to suggest the performance of a GP's next fund is totally unpredictable? Or, put another way, track record has no bearing whatsoever on the performance of a GP's next fund? I don't believe that. And I think everyone tuning into this talk probably doesn't believe it either. And I think if you're an LP in venture funds, I've never heard of an LP saying, performance is, how do I pick GPs? I just do it randomly because track record doesn't matter. So I don't believe this and you don't believe this. And so what this talk is about is about trying to find signals that do link track record to future performance. And I think it's useful to develop such a signal. I think we need to unpack why IRR doesn't work. So what we're trying to do is find a link between the present IRR of Fund 1 and the future IRR of Fund 2. And that's going to involve 2 jumps. And the reason IRR doesn't work is that both of those jumps have a lot of noise to them. So the first jump is, a GP's fund has an IRR today. What's that IRR going to look like sort of at the end of the fund, 3-5 years? And this is data from PitchBook here. It is very, very noisy. So the correlation here is roughly about 0.3 between current IRR and final IRR of a fund. So if you have, it is only modestly predictive, which is a little bit surprising. IRRs tend to not maintain. Perhaps some of the reason why is the use of warehousing, capital call lines of credit. There are some tricks that GPs can use that of course have legitimate purposes as well, but there are techniques that GPs can use to sort of artificially increase their IRR when they're raising for the next fund that may not be future predictive of the IRR of that fund. I think that's what's happening here. The second jump is the relationship between the performance of a fund and the next fund when we measure it at the same time. So here I just used PitchBook data, a big PitchBook fund dump, and x-axis is the current fund percentile, the y-axis is the successor's fund percentile. Correlation here is surprisingly about 0.2, even though this looks like a random scatter plot to me. You would not be mistaken to say, boy, that doesn't seem like there's that much of a link at all for that one. So what we've done is we've now stacked 2 noisy processes. Current fund's IRR doesn't have that much to do with its future IRR, and a fund to its successor fund is very, very noisy. We're stacking these 2 noisy processes. That's why there's essentially no predictive value to IRR. I also want to mention, and this is particularly important, that IRR is very fragile, specifically for early stage GPs. So just to think through an experiment here, you can imagine an early stage GP that made 10 investments 3 years ago, and 9 of them have returned the fund net of fees. So the 10th highest performing investment has actually an incredible amount of leverage on the way that fund is perceived. What I mean is, if that 10th highest performing investment is a 5x, the GP ends up with a just under 12% net IRR, If you put those numbers in the fund performance calculator, you'll see a 19th percentile, so bottom quartile. If that 10th investment is a 12x, the GP will have a little bit over a 25% net IRR, which actually turns out to be about 50th percentile. And if the GP hits it out of the park and gets a 30x, that'll be more than a 50% IRR, which is 87th percentile, top quartile. Put another way, with IRR, the difference between a GP whose next fund you want to back and whose next fund you're like, I don't want to invest in that bottom quartile GP's next fund, is a Series C markup that GP had nothing to do with. And I think there's an assumption that we're making here that I think is informed by my own experience as an early stage GP, which is that if GP still exists, it's most likely to be found in getting their startup's investments to the next round. And this directs us towards looking for GP skill in markups. And the nice thing about markups is that markups are a beautiful fit for the data that we have at AngelList, where we track kind of each month the price per share of 20,000 venture investments. That's a very unique data set, especially for early stage investments, where you might not be informed of fundraisers for several months after the fact, if you're not kind of directly on cap tables the way AngelList is. I think it is useful to get into definitions here, though. What do I mean by a markup? A markup means that another investor bought stock at a higher price per share than you paid. So I said stock. Safes don't count for markups, right? If you have a company that raises a safe at a 12 million post, and then they raise another one at 15, and then another one at 18, unless there's priced equity happening, those are not markups. So number one is like safes don't count here. The second implication here is that once this is a switch that gets flipped as soon as the priced equity is purchased. So even if the company, you make a seed investment, it gets to Series A at a higher price, and then the company goes to zero, that investment still counts as a markup because in fact, it did qualify by the definition. A different investor did buy equity at a higher price per share than you paid. The implication here is that when you plot the markup rate over time, it must be a non-decreasing function, because once a deal is a markup, it always stays a markup by our definition. So I think it's useful to be really precise here, because I think both of these, if we had a different definition, I think it might result in different results. So it's useful to be very precise about what we mean by a markup. What we found is that the two factors that most influence markups are months since investment, like how long ago you made the investment, and the investment round. So here's what those markup curves look like most recently. So this is plotting kind of as you go down. So the x-axis here is the months since the investment was made, 0 through 36, the first 3 years of holding. The y-axis is the baseline rate of markups for each investment, going down Series B, Series A, seed, and pre-seed. So for instance, the baseline rate, looking from all the investments on AngelList of a seed investment, is about a 54% markup rate after 36 months for seed investments, for instance. And you can see kind of as pre-seed investments have the lowest markup rates. The implication of this is something like, I've heard some GPs say, well, I'm an investor and 70% of my deals have been marked up. And I think it's a real question, is like the question you're supposed to ask is, well, what are those investments? If you made a bunch of Series A investments 4 or 5 years ago, that may not be, the 70% markup rate may not be impressive at all. Whereas if you were making, pre-seed investments 18 months ago, a 70% markup rate is really, really impressive. What I like about markups is that markups can solve the two big challenges for a track record signal, because they're both robust and timely. Robust in a statistical sense because these are binary, right? It's either a 0 or a 1, and once it's a 1, it stays a 1. We're not looking at the amount of markups. We're not looking if you do a seed investment and the company makes it to Series B, that's not 2 markups. It's just, it was a binary 0. When it got to Series A, it was probably a binary 1. I think markup timeliness is the more interesting thing here. This is one of the more unexpected results, I think, from our data, which is that markups become informative really fast. So we had a blog post a few months ago looking at the sort of interesting conclusions from watching your investments season over time and understanding kind of the rate, like is this investment ever going to be marked up? The implication being that if your investment, some fraction of investments are marked up every single month, but if your investment was never destined to be marked up, you'll of course never observe it marked up over time. And so what you get is you see sort of the probability that an investment is ever marked up starts falling as soon as it's, with each successive month after it's made, but that in fact for seed investments, it gets to under 50% after just 12 months. For Series A investments, it gets to under 50% after just 18 months. Put another way, for every investment but pre-seed, if it hasn't been marked up, there's a 50% chance it ever will in between 12 and 18 months. And that's not the case for pre-seed because our sort of prior rate of pre-seed markups is actually less than 50%. Another way, closely related, of looking at this is that half of all markups, regardless of the round, will have happened just 18 months in. So recall the issues with timeliness that we were talking about before, right? When you're talking about the complete distributed capital of a venture fund, that is 12 plus years. Whereas with markups, suddenly we have a measure where like 12 to 18 months in, you can start saying something really significant about what's going on here. And I think the fundamental question that we're trying to look at and the signal that I'm proposing is how many of a GP's investments have been marked up versus what we would expect. And we're going to call that markups over baseline. But what do we mean by baseline? There's an idiosyncratic baseline component for each GP, but there's also a global non-idiosyncratic component for what we would expect to see for markups. And that's because baseline markup rates change with market conditions. And what we're going to do when we develop markups over baseline is we're going to scale those historical markup curves, based on the 20,000 venture investments on AngelList, so that the actual markup rate of the investments we're actually trying to evaluate matches the expected markup rate from those curves. And I bring this up because it's very significant right now. The adjustment is minus 38%. I just reran this for November. It is minus 38% on those curves. What that means is I think, as most of the folks tuning into this to this chat know, it's been a really rough stretch for investments made in the past 3 years. Again, 38% lower rate of markups than what has been historical data. By the way, that historical data, of course, not only includes the decade on AngelList and the pandemic bubble, but it also includes all the investments that got made that have not been getting marked up. So it's, this, in some sense, it's even higher than it was. This 38% may be even more extreme than what we're quoting. We do this scaling so that GPs are neither punished nor rewarded for having invested frequently. It's a separate question whether you really think kind of GPs have market timing, whether a GP is, new to make a lot of investments in 2018 and 2019, but then understood to not make investments in 2021. We're making the assumption that that doesn't exist. It may, but we don't think it does. So we want to neither punish nor reward GPs for having invested frequently. For instance, if we didn't make this correction now, our most prolific GPs on the platform would all have terrible markups over baseline scores just because they've made a lot of investments that have performed below historical averages. We're saying that's not a GP's fault. There's a market condition thing that's not idiosyncratic there. What is idiosyncratic is that each GP has their own baseline from the investments they've made over the past 3 years. So I'm going to walk through how we actually calculate markups over baseline. There's 3 steps. The first is it's actually quite easy, right? Count up all the GP's marked up investments. So again, this is just a 0 or 1 based on, has another investor paid a higher price per share than what the GP paid. Step 2, we subtract the expected number of markups from that number by summing across investments. That's the baseline. So what investments are we summing up after? What does this mean? Just to work through an example, if a GP made a Series A investment in October 2021, right now that would have an expected markup rate of about 28%. So we would subtract 0.28 from the GP's markup count for this investment. And so the end result is sort of a count of markups over expected markups, or markups over the GP's baseline. We have to divide the resulting number by square root n to standardize the values. Again, we're trying to neither punish nor reward GPs for being frequent investors. The reason we do this is so we don't unduly punish or reward the most prolific investors on the platform. And this produces a score value in a statistical sense. The reason that this works is because the adjustment we made to the markup curves, we've created an environment where if a GP made some investment over the past 3 years, it sort of is designed to have a 0 expectation, actual versus expected markups. This is from our signal development of markups over baseline back in 2020. Looking at the current markups over baseline score to the IRR of future investments that were made. The correlation here is about 0.3, depending on other cuts, it can get up to maybe 0.35, 0.4. If you are interested in seeing how we are, a more recent cut of this data or how we're applying it, I would very much encourage you to reach out to me. You can see my email address at the end of this talk. I do want to mention, markups are not perfect. And I think probably the most interesting pushback against using markups is what I would dub the Europe problem. And I dub that for 2 reasons, both a specific example as well as a stereotype. So if I were a GP and I knew you were trying to evaluate me based on the number of markups over expected values I get, I would be tempted to, how would I game this statistic? I'd game the statistic probably by doing like uncapped 10% discounted safes immediately before a priced equity round. And that would give me technically a markup, right? Because I'm paying 10% less price per share than the next investor. Does this actually happen in practice? I don't think so, and I want to be specific about this. So actually, when we first developed this signal back in 2020, the highest ranking investor, or top 5 on the platform, was a prolific AngelList GP that had a lot of operations and was a European investor. And so you think the stereotype of like, well, European VC, it's like a little bit safer, but the returns are worse. And we were the IRR for this GP wasn't super high. It was good, but it wasn't great. Their markups over baseline score was really great though. And we're like, have we just identified a way of finding European investors? And one of the things that's interesting is that now, currently, markups over baseline was actually very predictive of that GP's future portfolio performance, because now they have one of the highest IRRs on the platform as well as having one of the highest markups over baseline. So I think we should be aware of this issue, but I'm not sure that we have the data to support this as a refutation of the markups concept. And I think the other thing is that we don't need to find a signal that works perfectly and explains everything in all cases. And what we can do is that we can use IRR as a complement or check on markups over baseline, as opposed to being kind of a useless primary predictor. So we can use, when we're thinking about a GP's performance, IRR as sort of a way of validating the results that we're seeing from markups over baseline to if you do have a GP that's like figured out a way to manufacture markups over baseline by hitting a bunch of signals, presumably they'd have a very low IRR and you'd be able to sort of flag that. Another surprising result, and the reason that that works, or you can use IRR and markups over baseline in tandem, is that IRR and markups over baseline are relatively uncorrelated. Correlation is about 0.4. This is what it looks like. I think this is actually data from a week ago of the nearly 400 prolific enough in GPs on the AngelList platform. The x-axis here is their markups over baseline score. The y-axis is the fund performance calculator percentile output of those GPs. And the size of the dots are the number of investments that GPs are making. And I think what is interesting is that the correlation here is relatively low, despite the fact that the correlation has to be positive, because it's very hard to make IRR if you're not getting markups, and it's very hard to get markups if you're not producing IRR. So there is they're both pointing at the same sort of positive phenomena, which suggests, of course, they are going to be correlated, but the correlation is not as high as you would expect. And in this context, kind of, what we're suggesting is the GPs that you'd want to invest in are the GPs, particularly the ones to the upper right, but more towards the right than the ones that are higher, more up, I suppose. So even with all this, even if you stack, markups over baseline score with IRR, maybe some other features and stuff, you're still future predictive. Your correlation to future performance is maybe 0.4, maybe 0.45. And if you want to, use R squared on that, I mean, you're talking about maybe predicting 20% of a GP's future performance from this pretty in-depth track record overview. So I don't want to say that we've solved the problem, right? Markups don't solve the problem of predicting future performance. It's still really random. But what I do want to say is that randomness, that's okay. And one reason it's okay is the past research I've done, right? When you invest in you should not invest in one startup. You should not invest in one GP. Our data very strongly suggests that LPs would benefit from investing very broadly. The LPs that have made the decision to invest in early stage venture should do so very broadly. So it's not like we're trying to use our fancy math to pick, the one GP that's going to have the highest performance in the future. No, we would ideally invest in dozens of the best GPs by our measure, and hope that the performance of those GPs would sort of come out. So there's the noise is tempered a bit by the fact that we are going to, ideally would be investing pretty broadly within this signal. I think the more important reason that the noise doesn't really matter is that, and this is very subtle, is actually around price. So another surprising thing I've found in my research is that startup deal prices are very responsive to common information. So, I hear from people all the time, what's the secret to picking startups? Is it to, invest in founders who worked at Google? Is it to invest in people who went to Harvard? My answer to all that is yes. Our data suggests those are certainly positive signals for future success. But you're going to pay for them. And in fact, what our research has shown is that actually the amount that you're going to pay for those positive signals almost wipes out the value of the positive signals. And so the reason that this is interesting in the context of picking GPs is that even though we only have a very, very, what we've developed here, I think is a very, very noisy and clouded view of the future performance of GPs, most every venture GP is charging the exact same amount. So in startups, as we've shown, kind of between the top quintile and bottom quintile for seed deals, there's a 5x spread. You don't see that in GP pricing, and as a result, if you have a little bit of insight, you don't have the price aspect pushing back against you. So if you have a little bit of alpha, a little bit of signal on the future, we think that you could actually do quite well. Even with a very noisy signal over future performance. I would encourage folks who are interested in seeing how we might be applying this research to email me directly. I'm abe@angelist.com. And I think we have some time for questions. So I'm going to pull this up here. Okay, one question. Is it fair to say that funds focused on concentrated ownership versus spray and pray performed better? I think that's an interesting question. I actually, you know, I think we've heard earlier today from GPs that employ both strategies. There are some GPs that look for concentrated ownership in the startups they invest in so they can have some measure of control and influence. And there are other GPs that will invest pretty broadly with much smaller checks and maybe have a lot less influence and control, but a lot more exposure. I think as a general principle, I think this has been a sort of consistent theme in the research that we have. It's that as an LP, what you want are GPs that are investing kind of within their area of expertise, that they can find credible deals. And that is the most important thing. I would actually say the form of investing within that area of expertise matters less, and that if you find a GP that has a lot of exposure to a sector that they feel really good about and they want to write small checks to it, that's sort of fine. I think the biggest challenge about it is that the idea to broadly index or spray and pray is really, it should be the policy on the LP level. So in kind of my construction of the world, like you'd have LPs that broadly index into GPs that have their individual areas of expertise. So you go broad among GPs who go narrow. I think the question or the problem becomes one when you think about GPs broadly indexing themselves. Our data, like I just sort of my own experience with doing early stage investing really has suggested that these areas of expertise do exist, that if you try to go outside of them, you don't do particularly well. I would say of the GPs or funds that I would sort of that I personally would trust to or think highly of in terms of broadly investing, I think there would pretty much be three, and they would be YC, Founders Fund, and Naval. I don't think that it's a good policy for a typical GP to spray and pray themselves, just because I don't think that they will have good deal flow or be able to evaluate things outside of the area of expertise. So, just on a personal level, we've joked, my friends and I who do Indicator, I would say the folks that I invest with have really good kind of deep tech experience and really good kind of fintech experience. And so we've joked that when we've done our portfolio reviews that we make three kinds of investments: deep tech, fintech, and bad. And we don't intentionally make bad investments, but certainly when we go over our portfolio, it certainly seems like those are the three categories. And it's when it certainly relates to when we go outside our areas of expertise, we tend to do quite badly. So I would say I would be careful if you heard a pitch from a GP who suggested broadly indexing themselves. I think it's very hard to get that. Like they better have a story about how they can really get very, very high quality deal flow among a bunch of different sectors and be able to adequately evaluate it. And I think it's pretty limited. Another question. Do you have a framework we can ask potential GPs to restate their track record in the form of markups rather than IRRs that we can use? Yes. So one of the things we're working on actually as part of the GP dashboard on AngelList is showing folks a markups over baseline score. And so we would GPs on AngelList would be able to share that with potential LPs in the future. I think it's something that is an interesting measure to look at. I also would just encourage, the nice thing about having that score value is it's a nice kind of interpretable value where positive is good and negative is not as good. But you can also look yourselves at sort of a portfolio of, what are the investments that make up a GP's current fund? How have they done? And really, I think the link there, that's a little bit of abuse of the term, but it's almost like looking at sort of earnings quality, like treating it the same way you would as sort of like earnings quality in like a publicly traded company. So like, is a GP's like, when you see a GP's prior fund, is all the performance coming from a single investment? And have the other investments not done very well? And if so, that could be a red flag, even again at a very, very early stage, right? Because we think markups are informative 12 to 18 months in. So I'm not, as much as I like this kind of markups over baseline score concept, I think if you're maybe a little bit less data inclined, I think looking at this thing holistically from where are these returns coming from that a GP is presenting, I think is a great way to go about it. Have you drawn any conclusions or hypotheses on timing exits? So I think that there is so when we think about the way that I would really kind of, and this is a question I think in particular, so the timing of exits, right? One of the unique things about venture is like you sort of pick your entry point, but you don't get to pick your exit, except for, of course, with the potential of taking secondaries. So I'm assuming this question is really sort of how do I know whether or not to take a secondary? I have an offer on the table, I'm a GP or I'm an LP that has this opportunity. Should I take, or should I encourage my GP to sell, their highest performing company? I would say that if you have those opportunities, like it's really a question of sort of your anticipated or expectation of the growth rate of those companies kind of on a forward basis. It is the case, for what we've done and the research we've done that has suggested that successful companies grow the fastest earliest. And so in some sense, there is a policy that would say you would actually do the best as an LP by selling as soon as possible and then taking that money and reinvesting it in new winning early stage opportunities. And I think it goes down to sort of your opportunity set as an LP and kind of your liquidity needs. The advantage of keeping the money in an investment is that if it does, obviously you have more money compounding, and it could be compounding if it stays at a very high rate. That's a wonderful thing. That's really nice. So I think that's the balance. In general, though, the direction would be towards if you have adequate early stage investment opportunity, would be towards taking liquidity sort of as early as you can get it and then reinvesting that money in early stage opportunities. Of course, I think the form of the LP really, the challenge of that, of course, is that you've taken an exit that is cash and you're now reinvesting it in a sector where it might be 12 plus years to get liquid again. So I think actually your need, the individual needs of you as an LP, whether it's an institutional LP or this is something you're just doing, or you're a dentist that's an accredited investor who's doing this on the side, I think is really like I guess I'm not really doctrinaire about this because I do think an individual LP's circumstances could change one way or the other, the right decision, and I don't think there's a one right policy for everybody. But the one thing I will say is that yes. If there is like a guiding principle, it's that winning investments grow fastest earliest. So, taking your gains and reinvesting them would be consistent with the data suggesting you'd have the highest growth of capital that way, but your experience may vary. For syndicates, Ale reports follow-on rate. So I actually think this is actually really, I actually think that this is a good, so this question is about follow-on rate, and does follow-on rate that AngelList reports have useful predictive power, given that it's not adjusted the same way we were talking about markups. I think follow-ons are actually really interesting as well. And the reason, I'm actually not sure if we count additional safes as follow-ons. I don't think we do, but one of the key differences that is actually surprisingly pertinent for right now is that I think as a lot of seed investors over the past few years have seen, and certainly a lot of my personal investments have done this, you make a seed investment, it gets a Series A, but it's not a markup, because the Series A investment ends up, net of all the safes the company raised or whatever, you end up just paying the Series A price. So the company, does get follow-on investment, possibly from a great investor. It gets to Series A. There's a professional venture capitalist joining the cap table. It is a follow-on, but it's not a markup. And the question is that relevant? Does that still have sort of predictability? And I think the answer is that we're going to need to wait a few years to really find that out, because it is, I think it's, does additional fundraising, if it's at the same price per share that you paid, is that a positive, negative, or neutral signal? The fact that kind of we've gone with markups is a suggestion that it's probably not as positive as markups, but it is something that I think we'll look at as we kind of continue to develop ways for GPs to share their performance with LPs in a more predictive way, and LPs to analyze. Kind of my vision of what this could look like on AngelList is really sort of a data buffet, because there's not really, and this is, I think, important, even though I've advocated in this talk for an increased use of markups and actually using markups beyond the way you'd use IRR or DPI. I think that these can be very valuable sort of check metrics on one another, and that the sort of the ideal GP would have, high DPI, high IRR, and a great markups over baseline score, or a great follow-on rate. And so I do think that there's sort of sharing this with LPs, I think is going to be, or getting to that point of sharing that information with LPs, or having a GP share that information with LPs to make their own decisions, I think is where we'd like to go in terms of operationalizing the data on the platform. All right, that is the time we have for the session. I wanted to thank everybody for tuning in today. I'm in a little bit of a unique situation. I'm actually doing a bit of a bookend here. So I have the last session, that's this one, on day one of AngelList Confidential, and you can tune back in tomorrow morning at 10 a.m. Pacific to catch me doing another data presentation. This is on less researchy, and that presentation will be on what happened in Q3 in venture, our state of venture report that we are doing alongside our friends at Ramp, who have their own very interesting data and perspective as well. And that session will also include some predictions on what we see happening in venture and startups for the fourth quarter of this year and for 2024. So I hope you'll tune in then tomorrow morning, but I hope you had a wonderful time tuning in to day one of AngelList Confidential. Thanks so much.